The Silicon Valley Bank blow-up has caused the Fed to reverse course on the shrinking of its balance sheet. As you can see behind me, the balance sheet has increased by about $400 billion over the past 3 weeks. This is primarily in short-term lending facilities where the banks are coming to a new specialized window and borrowing against their bond portfolio, which has lots of unrealized losses in it. So the Fed is giving them the ability to borrow against those securities as if the securities had not gone down in value. So this is a very nice way to provide liquidity to the banks, very big subsidy for the banks, and it is hoping to stem the deposit run that has been occurring at medium and small banks. So the Silicon Valley Bank basically got started with the large unrealized losses in their portfolio. They sold them, and then the depositors started to drain money out of Silicon Valley Bank, causing the company to need to seek aid, and the FDIC took over the bank and has repositioned it since then. Depositors across the country, seeing that, have started taking their money out of mid-size and smaller banks with their deposits and moving them either to money market funds or into treasuries, or possibly even into larger, the national banks that are really too big to fail and have been proven too big to fail in the past. So these deposit drains coming out of the medium and small banks means that there's less liquidity in those banks to lend money. So credit conditions are tightening. It's going to be more difficult for businesses to borrow money, to do expansions, build a plant, possibly make an acquisition, and other home builders to borrow money, construction to borrow money. All these items are going to have much tighter credit conditions, and we're going to have a situation where the economy is going to slow because of tighter credit. This should be the final nail to finally push the economy into a recession. We did have a brief, very shallow recession last year, but we did have a nice little rebound in the fourth quarter and the first quarter, but it does look like we're going to roll back over into recession, primarily because of this credit tightening. The other item that's been increasing the cost and slowing down the economy is higher interest rates. So not only has the short-term Fed funds rate gone up dramatically, also longer-term rates have gone up. Longer-term rates are tied to mortgages. Mortgage rates has really shot up from where it was a year and a half ago, and it's making it much more difficult for homeowners to buy homes or even upgrade to larger homes. So that's also a dampening effect on the economy. Which is not obvious in this chart behind me, where you see this big uptick in $400 billion in the balance sheet, primarily because of these short-term lending facilities to banks, is that QT has also been on pause. So the balance sheet is made up partially of treasuries, partially of loans, and so the treasuries have only shrunk by $6 billion over the past few weeks since Silicon Valley Bank. If they had been on the promised path, they would have shrunk by about $74 billion. Interesting enough, it does look like there's about $90 billion of treasuries that matured March 31st. The Fed will have to report on that, whether they roll them over, which they have done before, or they actually let them mature, took the cash back, draining liquidity out of the system, and shrinking their balance sheet, reigniting quantitative tightening. We'll know that Thursday evening when the Fed reports this information. So keep in mind that this is a very dynamic situation. No one knows exactly what's going to happen. The Fed is going to make some moves that possibly, are unpredictable. It does look like the Fed is very worried about the economy and is coming to a close on raising the Fed's funds rate. Possibly one more raise seems to be the consensus currently. But they have emphasized that they're going to continue with quantitative tightening. We're going to see if that's all noise, just trying to dampen inflation expectations, or if they're really serious about resuming quantitative tightening. If they resume quantitative tightening, that is clearly a negative for liquidity, negative for stock and bond prices. So keep an eye on that, Thursday's report. I'll also point out, a key thing to remember here is that the Federal Reserve really doesn't care whether you as a stockholder lose money in the stock market. They do care about the big banks in this country and making sure that they stay intact and that they are bailed out under any and all circumstances. So that is the key thing the Federal Reserve focuses on. The rest of it, they basically pay lip service to. Inflation, unemployment, that's really not their biggest concern. And you see this, crony capitalism as the members of the Fed, work for the Fed, then jump over to Wall Street for very lucrative jobs, jump back and forth to Treasury Department. It's quite an incestuous situation. The other thing to keep in mind is the big banks don't really care about shareholders. Once again, it's been proven how stupid the banks are. The banks in total have lost hundreds of billions of dollars in unrealized losses on their balance sheet from holding treasuries. Well, this is quite remarkable given that the Fed and Powell had made it crystal clear that interest rates were going to be going up. He gave them plenty of notice to reposition their portfolio. It is complete and utter incompetence that allowed them to have these hundreds of billions of dollars in unrealized losses in their portfolio, creating this current financial crisis. I'm sure Powell, to some extent, is going, wow, what else could I have done so that the banks could have and should have reduced their duration risk? They did nothing, even though he made it crystal clear that they should be reducing their duration risk. Complete incompetence in the banking system. You can never underestimate how dumb bankers are. So it's an industry I've generally stayed out of. I did dip my toe into Citigroup and US Bank at the end of last year, but I've since sold those after realizing that this is a bad industry, and the industry is actually run for the employees, not for the shareholders. It's an industry basically to stay away from on a longer term basis. So this is a lot going on, very unpredictable situation. Keep a fair amount of cash, pick and choose your entry points. There do appear to be select cases where things can look very attractive and compelling. Don't freeze out completely. Use those opportunities to buy attractive companies, but do not try to put all your money back to work and try to get extremely long at this point, in my opinion. I do think we're rolling into a recession. I don't know whether QT is going to resume, and I do expect the Fed to at least do one more rate increase, all of which could be possibly add volatility and downward pressure to the stock market. I hope you find this information helpful. Please take a look at our full disclaimer at buildingbenjamins.com, where we explain this is educational information and not investment advice. You can also sign up to get text and email alerts so you can get this information on a timely basis, and also get our information as far as details, as far as our thoughts on stocks there in a more timely basis than you can get on this video channel. Hope this is helpful. Have a great day. Thank you.